Thanks for joining. I'm going to work through some slides. I will provide the slides after the webinar, so just sit tight and enjoy, and then we will eventually move into the Excel file and do some hands-on work. Just a plug for REFM. We offer everything that you see here. Business is really picking up, so I'm sensing the real estate market is starting to turn a little bit. I know it's not a speedboat, it's a super tanker, so when it does turn, it takes a while to turn. But please do let us know if we can help in any way. We provide tools and training and certification and everything else that you see on our website. Okay, and so we are also offering a promotion today, which you can apply anytime this week to any single transaction, so you can buy multiple products or just one product. And this is the coupon residual _ land, which you can enter during the checkout process of the purchase process. Okay, now the first thing that we want to talk about in respect to today's topic, which is, well, how does a developer know what they should pay for a developable site? This is really a very interesting question and something that I used to wonder about when I was growing up. I would see these sites, traveling on the, family car trips and so on and so forth, and see these sites and it says land for sale or something like that, and you just wonder, well, how does somebody know how much they should pay for that? Okay. And naturally, I think everybody would agree that a piece of land is worth what can be put on that piece of land, barring very unique situations such as a land trust where there's a group that comes together to protect or preserve certain land for its natural beauty. Land that is developable gains its value from the uses or the single use that can, in fact, be put on that land. Okay, and so to that effect, what I want to talk about is, what of the elements involved in real estate development, okay, does the developer have control over, and if they do have control, to what extent do they have control over those various elements? Okay, and let's just work our way down from the top. Okay, the hard costs, the developer, no matter how big the developer, no matter how shiny their Bentley, okay, they have very little control over hard costs, because hard costs are really just a reflection of global commodities prices, okay, for timber and concrete and steel and so on, and then construction labor costs, okay, again, no matter how big, how wealthy the developer, okay, unless they are using their own in-house construction force, but even so, they're going to want to apply some sort of reasonable transfer price within the company. They have very little control over construction labor costs, okay? And so that's 50 to 60% of your total project cost or total development budget right there, okay? Well, what about the soft costs? How much control does the developer have over those items? Well, the developer, again, no matter how big of a client they are for a law firm, they probably can't just slash the hourly fees of the land use council and the transaction council and so on and so forth, okay? And so they don't have a whole lot of pricing power there. The cost of construction debt or financing, again, these are global markets. The developer is a price taker, not a price maker, okay? And then with respect to the returns that their investor is going to require, again, they can search around and find different investors that have different returns thresholds, but really the investor that matches to the development project is an investor that is willing to tolerate a higher level of risk because of the nature of development as a very risky enterprise, but as a result, they will want to be rewarded. Okay, so they don't have a whole heck of a lot of control over what the investors' returns thresholds will be. Okay, and so that leaves us with one last thing, which is, well, what about the land? Okay, and so now this is where we start to think about, well, what is it here that is unique and specific to land that can potentially give the developer more than just a little bit of control. Okay, and this is also going to be a very large ticket price on the land. The land is typically, for commercial development, going to be anywhere between 15 and 25% of the total project cost. Okay, and for a $100 million project, that's a humongous price tag. So what is it about land that makes it different? Okay, and so what I'm going to put forth is that land is different from the other development costs in that no single piece of land, no site, receives a constant high volume of purchase offers, for instance, every month of the year, okay, no matter how desirable your piece of land. Every site is entirely unique with respect to its location, geography, and the physical nature of the site. And sites often have zoning restrictions that limit the types of uses that can exist on the site, okay? And so because we operate in the real estate business within a cycle, certain property types are going to become more desirable to develop during certain years of a decade than others, and then they switch places. But really what we have with respect to a piece of land is the ultimate illiquid asset, okay? And so in my opinion, land sellers should feel very lucky, okay, when they get an offer that would in fact truly go to closing at that offering price, okay? And so if the land seller is interested in selling, okay, again, this is probably a big ticket price. They want $25 million, but somebody who is serious and who has the ability to close as they promised to comes in at $22 million, okay, well, there might be some serious flexibility there, okay? There also might be some serious flexibility on the price given the timing, okay? The land seller might have other financial obligations that they need to take care of, and they need to close within 90 days as opposed to 3 years from now when construction would start, and that can make the price flex as well, okay? And so if we can get our heads around that notion and agree with it, we can go ahead and start to talk a little bit about this notion of the validity of residual land valuation. Okay? And so the basics of residual land valuation is that this is one of the methods, not the only one, but one of the methods that developers use to decide what to pay for a development site. Okay? And the elements that go into this analysis are listed here on the left, and the developer's internal monologue, or the questions that they're asking or discussing in their own head, appear on the same row. Okay, so the first element that factors in to residual land valuation is, well, what is the estimated income, okay, that could result from the development of a property on the subject piece of land? Okay, and the questions that the developer is asking in their head relative to income are, well, what can I build on the land? Okay, and that's going to be based off the zoning and so on and so forth. Okay, and then the next thing is, well, if I'm building a structure, what in income can I squeeze out of that physical structure? Okay, it's in a very crude manner. Okay, development is just about squeezing money out of a box. Okay, so how much income can I extract from that asset? And in the case of an income-producing asset, such as an office building, that's going to be in rents. And in the case of a unit-based asset, such as a housing development or a residential condominium building, that's going to be income in the form of sales, okay, for each of those units. So that's the first element, and that we can refer to as the top line, okay, just like gross sales, okay? And so now, naturally, there's always the cost of goods sold. What is it going to cost? What's the estimated cost in order to bring this vision to fruition, okay, create this asset where there previously was nothing? What's it going to cost me in total to build, operate, and then lease up the asset to the point of stabilization or sell it out, okay? And so that naturally is going to take a big chunk off of our estimated income. And then the third piece, which is often the piece that people will overlook, okay, before we get to the residual land value is, well, what is the required return? Okay, I'm going through this process. I'm going to spend 3 to 5 to 7 years of my life and put my people to work, okay, over that time period. well, what do I need to make in order to make it worth my while? Okay, and what do my equity investors need to make? The bank's going to tell me what they need to make, and that's simply going to be part of the cost. But the equity investors, okay, they're going to be targeting a certain level of return. Okay, and so as we say below in the asterisk, okay, for income-producing properties such as an office building, that margin that we're talking about is going to be typically measured as yield on cost, which is our NOI or net operating income divided by the total project cost. And then for unit sales projects such as a condominium development, it's typically measured as a profit margin, which is our net cash flow divided by the gross sale proceeds. Okay? And so if we deduct from the top line the estimated income, okay, we deduct from that the estimated cost and then the required return, what are we left with? Okay? Well, if in our estimated cost we simply did not include the land value, then we are in fact left with the land value, and that is the residual amount, or the residue, or in essence, what is left over after everything else is scraped away. Okay? And so that is the conclusion, the mathematical basis for how a developer gets to the point of saying, well, this is what the land is worth. Okay? This is what the land is worth for the project that is being contemplated. Okay? I see a couple questions have come through, so thank you for sending questions. If you can just wait until the end, since it is such a short period, the slides are going to be available to answer some questions. The Excel is linked off our web page now, the page for the actual event. Okay? Now, if we can get our heads around this and get comfortable with this, now what we want to do is understand, well, what is the process that we go through, and then how do we put a spreadsheet to work for us such that we can try to gain some clarity with respect to what a property is worth. Okay? And so the first pass, the first thing that we're going to do without investing a whole ton of time and energy is we are going to do a back-of-the-envelope analysis. Some people call it a back-of-the-napkin analysis, but this is also known as a static analysis, okay? Meaning that in this analysis, we're not really taking the passage of time into account, okay? So what we're saying in a back-of-the-envelope analysis is, okay, if I could snap my fingers and the building that I'm contemplating would just appear on the site, okay, as I snap my fingers, okay, what would the economics of the building look like? And by doing the math, how much would I, in essence, be able and willing to pay for the land given some target economics, okay? And so what we do with this back-of-the-envelope analysis is we're going to make inputs into this back-of-the-envelope model, which we have in our Excel file here, and which we also have on our website. We have back-of-the-envelope models for basically every development of every asset type, so please take advantage of those. They are free when you enter the coupon code. So we're basically going to make inputs for all of the variables, including the land cost, and then, given how the returns look, we're going to make iterative changes to those variables within reason, and especially to the land cost, such that we can converge upon the appropriate economics. Okay? So once we achieve that hurdle, say it's an 8% return for a yield on cost, or it's a 20% profit margin for a condominium project, okay, then we need to say, all right, well, is this land cost that I have input, okay, that allows me to achieve my threshold return, is that something that the land seller would be interested in, okay, or is it totally out of bounds? He's asking 25 and we're saying that we can't pay a penny more than 12, okay? If it's nowhere in the realm, then just move on, okay? Just move on to the next project. And sometimes the economics don't work, okay? In certain markets, land is worth less than zero, okay? Naturally, we want to find those markets where land has some value because the value is coming from the ability to make income on the asset that sits on that land. Okay? And so if the land cost is something that you think the seller would entertain, okay, then we're going to take it to the next level of analysis, which is to proceed to running a multi-year projection model, which is also known as a Proforma. Okay, and what this does, which is different from what the back of the envelopes do, is this allocates our project costs, okay, and the anticipated income generated from the asset over multiple periods of time, okay, looking into the future. It's a forecast over multiple months, multiple years, okay? And then this is a much more complicated and in-depth and thorough analysis, okay, that all of our Excel models that we sell on the REFM website address. And then we can look at measurements for performance such as net present value and internal rate of return and multiple on equity, okay, that will allow us to fine-tune the amount that we would actually offer as the land purchase price. Okay, so what we're going to be doing today is we're going to look first at a back-of-the-envelope analysis, okay, for an office building. And so we have this basic analysis laid out here on the slides, and I realize we're running a little bit tight on time, so why don't we all go ahead and just transition over to the Excel at this point. We can look at that same exact information in the Excel. Okay, and so I'm going to click into the Excel, and then I'm clicking on the tab that says Office Model, and I'm just going to go ahead and zoom in here so that this is easily viewed. And so what I recommend you do at this point, take a second to, on your computer screen, okay, arrange your Excel window and your GoToWebinar viewer window such that you can see both at the same time. Okay, so you can follow sort of what I'm doing and watch that, but at the same time you can manipulate the actual Excel file on your desktop. Okay, and let's now start to step through this. Okay, now what we have here is a basic setup, and what we've done is we have broken out the inputs for this back-of-the-envelope model into various sections which are very explicit, okay? And so the first thing that we ask, okay, is, well, what can I build, okay? And what is required in order to build that product, okay? And that's relative to the zoning. Okay, so let's say we have a lot that has a square footage of 25,000 square feet, roughly half an acre, and the zoning allows for an 8.0 FAR, which dictates to us that we could build a building above grade of up to and including 200,000 FAR, which is equivalent to 200,000 gross square feet above grade. Okay? And so if we assume that this is going to be a mixed-use asset, there's going to be some retail at grade, we can make an input for that. Okay? Again, everything that we see here in blue, this is a user input. These are the values that you are intended to change when you run your analyses through the model. Okay, everything else, there's nothing locked, but everything else is not really intended to be changed by you and is simply a calculation-based output. Okay, and so if we simply subtract the 12,000 of retail use from the 200,000 gross of the entire building, that leaves us with a residual gross square footage dedicated to the office use of 188,000 gross square feet. Okay, and then that's good to know, but really in order to generate the income amount, we need to now adjust that to how much of that is rentable, okay? And so we apply an efficiency factor, which we're currently running at 91% here, and what this tells us is for this 200,000 square foot building, we can rent out roughly 170,000 square feet. Okay, and then with respect to requirements, okay, there's often going to be a parking requirement that is linked to the size of the asset with respect to the rentable square feet. So if we assume that the zoning says you're going to need 1.2 spots for every 1,000 rentable square feet, this is how many parking spaces that we would need. Okay, so this just gives us a basic idea of the physical manifestation of the asset. Okay, next is, well, what could I generate in net operating income? So now I'm going to put in, okay, with the data that I have from the market, I'm going to put in an estimate for what I think the average rent on an annual per square foot basis would be for this asset. Okay, and then if the parking is going to generate income, which typically for office it will, I'll put that assumption in as well. Okay, and so to do a very simple income estimate, I simply will multiply the $170,000 rentable by the $65 per square foot per year, and I can do the same for the parking, and then I multiply that by 12 since the $200 was a monthly cost. Okay, and then I can back out some sort of systemic vacancy across both of those. And this is going to tell me that my total annual revenue, okay, is roughly for this building. Again, if I could snap my fingers, this building would generate roughly $11 million a year in revenue. Okay, well, naturally, I always have operating expenses, so I now want to apply those operating expenses against my rentable square footage of the office, so I do that, and then real estate taxes as well. Okay, the retail component I'm going to assume is a triple net just for the sake of the ease of the analysis. Okay, working through one of these back of the envelope models should take 60 to 90 seconds. Okay, just with plugging all these inputs in. And so for the retail, I say, well, if it's triple net, I'm going to be able to generate $420,000 a year. Okay, so again, if I could snap my fingers and the building would appear and I would achieve these rents, this is what the current stabilized net operating income for the asset would be. So roughly $6 million a year. Okay, so that's something that I put a pin in that, and I now proceed to the next part of the analysis, which is, well, how long would it take to build this building, okay, and then stabilize it? So now I can put in my assumptions for the various durations of pre-construction, the construction, and then the lease-up period, okay? And then next, look at my costs, okay? Costs for the base building, costs for TIs and for the office and retail, the soft costs, okay? And then in addition, how much of interest or financing costs, okay, I expect to incur given an assumed loan amount over this assumed loan carry period, okay? And then I will, in fact, enter an input into the land cost, okay? And let's just say this is our starting point of $13.5 million, and so at the end of the day, we have roughly $100 million total project cost, okay? And so now, given that cost and given the assumed current stabilized NOI, again, if I could snap my fingers and the building would appear, what we're essentially saying is that this would generate a 6 cap, okay? And so this gives me a general notion, given all of these assumptions, of the basic economics of the building, okay? And so if that looks reasonable to us, then we can proceed to the next part, which is, well, how would I fund the project? Well, we said up top here that we had a 65% assumed loan to project cost, and our total project cost was $100 million. Okay, and so that's roughly a $64 million loan. And if there's going to be a mezz piece, we enter that in there, and that'll calculate, and then the residual equity requirement will be calculated for us. Okay, so we have a match now between the total uses of funds and the total sources of funds. Okay, and so this allows me to think through this process of okay, is the project feasible economics with respect to economics, and is it feasible with respect to could I raise the capital? Okay, there might not be any mezzanine funding in the market. You might need to go in at 35% equity, and then you need to ask yourself the question, okay, could I in fact go out and raise $33 or $34 million for this project? And you need to be critical about that. Okay, and so the last thing that we do in part of this analysis is we do, in fact, in the REFM back of the envelope models, we do cheat a little bit, and we make them a little bit better than your typical back of the envelope, because we do now think about the passage of time, and we say the following. We say, well, I know that this is going to be a long process, okay, to get to the point where the building is, in fact, tenanted and stabilized, and I can then, if I wish, remarket it for sale, okay? And so we say, well, there's going to be some escalations on the rents, and there's always going to be expense inflation, and then my number of years to stabilization is simply calculated based off of this number of months that I had calculated above, okay? So what I can do now is from the $6 million current stabilized NOI, I can project forward and say, okay, 6 years from now, this would be, in fact, my stabilized NOI, which applies to the year after the year of stabilization, okay, assuming these growth rates. So we apply the growth rates both to the income and to the expenses, and then we back out a reserve for capital expenditures, and this is where we get. Okay, so again, if this future stabilized yield on cost seems reasonable to us, then we can continue with the analysis. We can take it a little bit further, and we can say, well, what value would we create if we sold the building at that point? And you can look at these values here, which don't include interim year cash flows, okay, which we make a note of here. But now, really, what the exercise is the following. Okay, we say, well, a 6 cap on today's income is not, in fact, sufficient. Okay, our investors are going to require an 8 cap. Okay, so if I'm going on this notion that I have essentially zero control over all of these other costs, now I need to start to adjust the land price. Okay, so, well, what if I only pay $12 million? Okay, that doesn't move the needle very much. Okay, well, what if I can offer him 10? Okay, now we're starting to get somewhere. Okay, and so really, if we wanted to target for, let's say, a 7 cap, what we can do here, which is a very useful and powerful feature of Excel, is use the goal seek tool. Okay, so in order to do that, what I'm going to do is I'm going to go to the Data tab and the What If analysis, and then select Goal Seek, and I'm going to do the following. I'm going to say, set this stabilized NOI yield on cost to a 0.07, which is my 7 cap, by changing the cell that has the land cost in it, okay, F46. And then I'm going to click OK. Okay, and Excel is going to essentially back into the value that's required to get me very close to the amount that it would be required to solve for a 7 cap. Okay, Excel has a little bit of a quirk where it doesn't always give you the exact amount. So now from here I could naturally take this down a little bit more to get even closer to an actual 7. Okay, so this is really, 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 really low. Okay, 12 bucks in FAR compared to where we started out. But that said, okay, maybe these values then need to be adjusted, and these values then need to be adjusted. Okay, the point here is that we are now going to go through this, go through every assumption again and again and again to make sure that we truly believe in it. Okay, and then eventually converge on this. And then if this looks palatable and the land price seems like something that the land seller would entertain, now we can then proceed, okay, to running a full-blown pro forma, a monthly analysis or an annual analysis. Okay, so that's the basic exercise of doing the residual land valuation, and that's for an office building. Okay, we have the same thing here on the next tab, but for a condominium building. Okay, so this is slightly different. But we're really asking all the same exact questions. Okay, what could I build? In this case, we're looking at it on a units basis. Well, I have 3 acres, and the zoning restricts me to 50 units per acre at a maximum. Okay, so that means I can build a 150-unit building. Okay, how much parking do I need, and so on. Okay, and so now what we can do is do the same exact analysis with respect to, well, what could I generate in income? Okay, with respect to the assets that I have available for sale. Okay, regular market units that are pre-sold, affordable units, storage, parking, and so on. Okay, and so these would be our gross proceeds here, and assuming we have a retail component as well, and we sell that separately as a separate commercial condominium, this could be our net proceeds for the retail. Okay, and so again, we're going to compare the budget, okay, to all of these income amounts, and now the returns analysis is slightly different because it's really we're building a product primarily for sale, unless we elect to hold on to the retail. Now we can look at the profit margin. Okay, so that would be our pre-tax profit divided by our gross sale proceeds. Okay, and again, if this looks palatable to us and this land price looks palatable to the land seller, then we can perhaps put in an offer. But again, every one of these blue inputs is going to require a lot of study and a lot of backup, and once we're happy with them, we can then drop them in to a full-blown analysis. Okay? And so those are the basics of the residual land valuation process, and we just have these broken out into their components on the slides. Okay? The next thing that I want to talk about is the other basic method of land valuation, which is the comparable sales method. Okay? And this is also known as comps for short. And basically, this is pretty straightforward, okay? We say, well, what similar sites have traded recently, okay, and at what price, okay? And the definition here of similar means, okay, the same uses are allowed on the site with respect to zoning. It sits in the same submarket, okay? And I'd like to also think of it in these terms, okay, there were a similarly sophisticated buyer and seller, or there's a comparable level of sophistication of the buyer and seller in that sale as there is going to be in the one that we are contemplating. Okay, and so those are the pieces of information that you can seek out, and you can get land comps naturally from your brokerage firms, research and data providers, but the question that arises is, well, can I trust them? Okay, and so naturally anything that you source from a third party that you personally have not been able to verify by seeing perhaps the records, okay, and the land records, you know, you should take these things with a grain of salt. Some things you can in fact go and verify in the public records, and more so online as well. Okay, and so the conclusion here is that neither one of these methods is right or wrong. They're both valid, and really what we want to do is use them in concert with one another, okay, and use them as a sanity check against one another. So if I'm running my back-of-the-envelope model and then I run my full-blown Proforma, and I'm coming up with a residual land valuation of $100 a square foot for the office building, and the comps, okay, for very similar transactions are at $85 a foot, I better have some really good reasons for why I'm paying, okay, such a big premium over what some other very sophisticated buyer and seller traded at, okay, and there might be very good reason for that difference in the nominal pricing. Okay, there might be something else that's going on behind the scenes that's not reflected, or rather that is reflected in the purchase price but isn't explicit to you. Okay, and so these are the things that you want to do. You want to push these answers essentially against one another to stress test them. Okay, and so this has been a very, very quick, concentrated treatment of residual land valuation. Thank you very much for joining. I can take about 5 minutes of questions. I did want to point your attention to tomorrow's webinar, which is part of our new Lunch and Learn series. Okay, this is called Truly Understanding IRR in Real Estate Transactions. IRR is one of the most used measurements of performance, and unfortunately one of the least understood, and it is a little bit tricky, okay, and so I'm going to help demystify that and make it such that you could explain IRR to your grandparents and they would get it. Okay, so let me open up the questions here and see if I can assist. So thank you for joining, and again, hopefully we see you tomorrow and other times in the future. All right, I'm just opening up the questions here. The question is, will the presentation being used for the webinar be available for download? Yes, I will follow up and send the presentation via email to you. Question from the phone was, is yield on cost the same as return on cost? Typically, yes. Those two terms are used interchangeably, but always be careful, okay, when you're getting quoted certain measurements of performance from another party, and ask them a very pointed question. How are you defining, okay, the return on cost? Do you mean the NOI divided by the total project cost? Is that what you mean? Okay, there's nothing wrong with asking that question, okay? Question from the phone: where can one obtain data regarding operating expenses, TI costs for office versus retail? Okay, the brokers. This is what they do. They study the markets. They know everything. A lot of these brokerage companies also have property management arms, especially the big national or global platforms, okay? So the property management platform at CB Richard Ellis, they manage these types of buildings. They know what it costs to operate, okay? TI costs, okay? You're going to want to talk to leasing brokers for office and leasing brokers for retail, okay? Other questions are the worksheets available for download and private use? The file that came with this webinar is free. It's yours to use. So please help yourself. Again, we also have on our website a whole bunch of these back of the envelope models in our free tools section. Okay, there's a link at the top of the page that says free tools, and you can simply check out, okay, we've got for hotel, apartment building, condo, and so on. So help yourself and enjoy, okay? Question: where do your hard and soft cost estimates come from? The way that we offer a service to the market is we provide the tools, okay? You as the client, you provide the inputs. A generic source for hard cost information, sort of as a first pass, is RS Means. They have a free 7-day trial at meanscostworks.com. I also have some other links on the resources page of my website and our blog. But when you get serious about a transaction, you're going to want to start to get conceptual bids from multiple general contractors for the actual asset, and those will be hopefully a more accurate reflection. Another question is, do you have any courses that teach advanced modeling on condo buildings or office buildings? Yes, we do hold trainings on a rolling basis all across the country, and we offer all of them online. So the best thing to do is to make sure that you open the emails when we send them out, because that often has the details, or just bookmark our training page, because we do update the schedule every 3 weeks or so. Another question is, have you seen one or a couple of assumptions in your proformas that emerge as the most commonly incorrect? Every assumption is incorrect, which is the unfortunate, sad truth, and makes our job a little bit disheartening sometimes. I'm just trying to think, you know, you really don't want to be far off on the cap rate. You don't want to be a universe away on your cap rate for the eventual sale. Your rents, okay, need to be pretty tight, okay? Your construction hard costs need to be as tight as possible. Unfortunately, every input, okay, affects the entire ecosystem of the model. So understanding the backup and the basis for every one of those inputs is really, that's your job, and it's very important. Another question is, what are the current investor requirements for return, yield, et cetera, on office and multifamily? These are the types of data points that you can get, you know, looking at some data from Real Capital Analytics, paying attention to news, talking to brokers, and looking at broker reports, many of which are available for free. But generally speaking, if it's a stabilized asset, okay, it depends on the buyer naturally, because if you're not using debt and your money only costs you 2%, okay, you'll take a 5 cap and you'll still make money on that. Okay, and it's going to depend on the market and the nature of the asset and the nature of the tenants and so on and so forth. But generally speaking, my humble opinion, anybody who invests in real estate, you know, for less than a 5% yield on cost, maybe is taking on a little bit too much stress for that low of a return. That said, okay, there are harbors in the storm that global capital seeks, and that will drive down cap rates, and you know, interest rates, generally speaking, are worth nothing right now. So, you know, I guess it's a relative yield that you're seeking at the end of the day. Any other questions? I've got about another minute before I need to run here. I have one other question here. Can you go over the general percentage assumptions for hard and soft costs? Okay. I do have a video on my blog. It's called Real Estate Development Basics, okay, which you can link to from the top of the blog, where I talk about typical proportions of hard costs and soft costs and land within a development project. So I'll point you there. For those who are attending the IRR webinar tomorrow, you can use your coupon towards that, by the way, if you have not yet purchased. It is tomorrow, Wednesday, okay, at 12:30 Eastern. So thank you all very much. Please let us know how we can help, and hope to see you tomorrow and in the future. Thank you all so much.